welcome to the Creative Living channel. This is Christiane Silveira, your host. Welcome. And today we're going to dive into the lending uh, arena. So, if you're a real estate investor and you have that question in the back of your mind that goes through the mind of everybody, is like, where am I going to find money? So, this show is for you. Come on in. I have some news for you. Maybe it's going to open up and you're going to be like, whoa, I see it now. I see what other people are doing and how they're doing it. It's going to make a lot of sense. So, besides going traditionally, right, the way that we're always used to doing things, and then you run out of, there's only so many houses you can buy, right? If you have that perfect credit score, perfect tax returns, everything, there's going to be a time that you're going to need something else. So for those that are in that category, and for the ones that are not as lucky and trying to figure out how can I get that piece of opportunity that the real estate creates. For one, I'm going to tell you, you guys, that me as a loan officer and a lending this world of lending, when you start making connections, things like start opening up more and opportunities start learning new ways of, because the economy the way it is and the interest rate the way it is, it's been very hard for the lenders now. They've been very strict. So inside the traditional lending, there's something called non-QM. So non-QM is our loans that are not backed by Fannie Mae and Fannie Mae and Freddie Mac. So those are the loans that they still go through the same scenario, as far as they're gonna need your credit score. So the higher you have, the better rates you get. But and there's something into that non-QM, besides bank statements, that if you have a business, your business do well, you can get your bank statements from your business from the last 2 years, and be able to qualify for a house. Gotta have good credit score. That's always come up. You always gotta work on a credit score, right? But so we have for the bank statements for the small business, and then there's something that's called DSCR. So that type of loan is anybody can use it. Like if you are a W-2 earner, if you are a small business owner, if you are, like do investments on the side, or like whatever your situation is, as long as you have an okay credit, you can get what the underwriter is going to look. It's not whether or not you qualify as a person to repay for their loan. They're going to check the property and see that property as a business and make sure the business earning the cash flow and the from their rental is going to pay the mortgage and have a little bit extra. So it's pretty simple. It is something that's been very popular, I would say, in the last 3 to 5 years. So that's the number one secret, I would say, that once you find the DSCR loan and you able and you know your numbers, you find a property and you say, hey, this property cost that this amount of money, this property is going to generate this kind of income through rental, you can start a DSCR. Call your lender and say, hey, I want to get a DSCR loan. They're going to ask about your credit, a few questions. The process is very simple. They send appraisal out. The appraiser is going to check first how much the house is worth, and second, they're going to check the comps to see if the rent that you're getting from that, or the income that that business is producing or the property is producing, is going to be higher than the mortgage that you're going to pay. So you see it. So mortgage payment, it's mortgage payment, your principal, interest, insurance, right? So all of this together, that total got to be less than what the rent that you're going to get. So as long as you can rent for that amount of your payment, a little bit extra, you should be fine. So that's the one that lenders do the most. That's what the investors use the most because it's the fastest way because it doesn't, there's not a limit. As long as your credit score is good, you're paying your stuff on time, everything's awesome. They're not gonna the underwriter, as long as the property can generate income and pay for the mortgage, you should be good. So, and then, the only thing that I would say about the SCR that happens a lot, I have my investors come to me and say, hey, but I have this distressed property. So I need a DSCR loan. No, it doesn't happen. DSCR loan, most lenders, it might change. Don't rely 100% on me. Call different lenders. Things change a lot into the lending industry. But if it's distressed, you gotta have to get another type of loan. DSCR is for turnkey homes or for homes that need a little bit of something. But if the home is good to be rented and for a certain amount that's higher than your mortgage payment, you're good to go. Distressed home, we're gonna talk now, get into our second lending strategy or secret, or I'm just trying to get you guys to understand and have some options. So that's called hard money lending. So all my investors out there look for fix and flip or have a property that is distressed, so you need to get the property up going before you go and rent it, or you need a hard money lender before and then a year later get a DSCR loan, that's fine. I'm going to talk and give you more details about what a hard money lender does for you. The traditional way of lending, right? You go, you check a property out, you like it, you think it's going to be a good investment. What do? You call the bank. So that's the traditional way of doing it, where they go through all your paperwork, make sure you have the ability to repay, check your credit scores, make sure everything aligns, and then you go through the process of the mortgage, which is it's very stressful, as a lot of people have been going through that process, especially lately. The interest rate is so high, so things are getting a lot more different this year than was the years before. So so let's go over the third option that I have here that I want to talk about, which is the private money lending. So as far as private money lending, me, I don't know about, but there's a lot of people that associate hard money lenders as, oh, this is higher interest rate, never do that. But if you are in a position that you need something to get you going, or you cannot get you don't have all your paperwork ready, but you found a good deal and you need funding ASAP, so you go to the hard money lender. The process is a lot easier. So you send your purchase agreement. They go over some questions with you. If you want to rehab money, you're going to have to show what you're doing, how much you're spending, show experience. So as long as you have all of that to get started with the loan, you should be able to go. Hard money lenders, they do charge a little bit more, and but if you see in the big scheme of things, it's not a lot. It's a short term lending, so it's only the loan is only good for a year. Most of the loans you can pay back in lesser time. Just double check if there's any prepayment penalty. I mean prepayment penalty. What does it mean? If you pay any sooner, if there's any fees that you have to pay. A lot of sometimes the hard money or some loans, it comes with that PPP, pre penalty fees. So be aware of that. But if you are in the industry and you want to flip homes and you want to do as many as you can, that's where you're gonna find your capital, right? So the hard money lenders, the same way as the whole industry itself has changed a little bit when it comes to interest rates higher. So they are looking more into each individual, and kind of doing see if the investor has experience. If you don't have as many experience, you get a higher rate, which is not a problem. Everybody needs to start somewhere. So always when you do your underwriting and you use a hard money lender money, make sure that you add the points, because usually they charge between 1 and 5 points, depending on a hard money lender. Uh, your interest rate, um, points, and closing costs. It's the attorney costs. It's the a lot of the hard money lenders, they do send appraiser there to appraise the condition of the property. And then once all of that established, you're good to go. The way that they do the rehab, with the funds for the rehab, if you need 50,000, 80,000, 150, they do it per draw. So most of the lenders, especially the ones that I work with, you're gonna start with phase one. You're gonna have that amount of money that you're gonna spend, which you've already been with the scope of work. You've already told them how long it's gonna take, what needs to be done. Once you're done with that phase, for you to draw more money, you need to send pictures, and there's some things that you need to do to make sure that you're in compliance, and they know, because hard money lenders, as you know, any traditional lender, they lend everywhere. So the rehab and construction, they want to make sure that you send in your pictures, that the project is flowing, and they are not giving you money for you to spend with something else. So they want to make sure for every phase you do it, get your money, go to the next phase, but you got to show that you're done with that, receipts, everything. So that's where hard money lender comes in. And then I'm going to talk about a third one that I think it's awesome, that I think it's the result of these times of interest rate, and that you see a lot of the short-term loans. What are short-term loans? So that's my third type of lending, and that's my favorite one. And that's the one that I do a lot as a private money lender. And I want to explain to you guys what it is. And and what is all, and I want you to think, besides learning those type of lending, what's going to be good for me. And if you have any questions, of course, put in the comments. And but it's so important to know there's other ways of investing, there's other ways to grow your portfolio. So let's get into the third one, the PML. So we have short terms and long terms. Oh, I love this one. Stay tuned. So private money lending, I get a lot of questions. What is the difference between private money lending, hard money lending? Usually, hard money lenders are going to be the big business, right? The deep, they have a lot of money because they have all of those investors that invest their money into investor, like what we are doing. So they have these big organizations, big banks that do the hard money lending, and hedge funds. That people out there, they have everything. They have the offices. And it's a different world from private money lending. Private money lenders are usually people like me and you, individuals that have some money, and they want to lend their money to people. So they can do a lending as far as first position. So you come, you look at a house, and you're doing, it's not owner occupied, they gotta be investment property. And then you get to the private money lender, people like me, and say, hey, I wanted to buy this house. So we go over all of the same way that hard money lender does. And we give you the funds for the house. We stay in first position, and then go 20 years, 5 years, 10 years, depending on private money lenders. So a lot of private money lenders, they do that. They like their money coming in every month, and they get the interest paid every month, the principal paid with the interest. So it's a little bit different. It's long term, but there's a lot of private money lenders that do short terms, like the same as hard money lenders, that does rehab, that they do the sponsors, all finance all of that. And there's also another kind of private money lenders that they do the short term. So they do like 3 month uh, lending, a month lending, weeks lending. Oh, what is that, right? So that's something that we call the short-term PMLs. So you come in as an investor, you fix and flip and say, hey, I got the house uh, that the distressed home. I have the hard money lender to fund the house, the property. Now I need the rehab, or I need the rehab, and I need you as a short PML to come up with the money for rehab and for the down payment for that property with a hard money lender. So you go into that as a second lender, which taking second position to the house. So the house, your security, right? So whatever it happens, if for example the project doesn't go as well, and things happen, you're protected because you have a lien against that property. So but the goal of the short-term lenders is to do what big institutions, hard money lenders, and a lot of private money lenders, more the traditional, they are not doing. They provide that chunk of money, and then for the less amount of time. So if you go to a hard money lender and say, hey, can I please have 50,000? They're like, oh, no way. I do. Like I know hard money lenders. They don't do anything less than 1 million. I know some hard money lenders they don't do anything less than 120,000. So there's those limits. So for everything else, there's those short-term PML or private money lenders that they're gonna look, they're gonna underwrite you're gonna ask for paperwork, and then everything's gonna happen with a closing attorney or title company, depending on the states that you are. The beauty of that people like me, that's a short-term PML, can land anywhere in the United States that I wanted to land, and everything can done through a closing attorney or a title company, depending where you are. And then you have a very important person that's a transaction coordinator that is going to be able to get all the paperwork to secure all the sides of the lender, the borrower, make sure everything gets paid on time and all the paperwork is correct. So that's one that has been growing a lot, this type of lending. It does not require, a lot of time. You can do your first position from your property, buy the property, have the hard money lender do the mortgage with them, come to us for your rehab cost or for any gap lending. Anything that is shorter term, of course, the interest rate is going to be a little bit higher because it's a little bit more riskier being in a second position than it is being in the first position. And it is a short term. That's the beauty of it. And it's less money that a hard money lender or pretty much a lot of lenders out there are not willing to lend. So that's it. So if you need money, you have those, all of the traditional lending, DSCR, hard money lending, private money lending, short-term private money lending. So you can get all your take care of your portfolio, take care of your fix and flip, and or anything that you need to. If you buy 2 houses at a time, you need gap funding, that money in between what you need, to put down to do your loan, and then you need extra money to pay for closing costs and the down payment. You can come and talk with a um, short-term private money lending. So, that's it for today. Hopefully this has opened up your mind and made you take actions and see like, okay, now I just need to network and to talk with people that can have the money, and then you have the money waiting, and as soon as you're ready to see a property, want to do a fix and flip, you have your contacts already. So if you have any questions, let me know in the comments. Glad to answer anything. Love everything about lending. So I'll talk to you later then.